And now let's have the partial year depreciation. For this, it basically means that we do not recognize the exact depreciation for a particular year. Say, for example, in the illustration, the company acquired a machine on September 1, for example, or in this case, it's really September 21, 20x1. Depending on the policy of the company, it's possible that even if, let's say, it is still going to be 21, it's not yet the end of the month, but it's going to be counted as 1 month. For some policies or accounting policies of the company, if ever, let's say, it goes beyond the 15 days, meaning half of the month, it's now considered like X for that month. So something like that. Accounting policies are very important for the organization or business. In the absence of that, which is the case in our problems, if ever that is the case, if we can notice at the bottom part, it's counted. We can check that on the example. First year for straight line, 4 years, useful life of 4 years. So that's why it is constant. And then for SYD, the total of 4 years is 10, 1 plus 2 plus 3 plus 4, and then decreasing 4, 3 to 1. We can check in the next page that for 20x1, it's actually 3/12 because in a year, there are 12 months. And then for the purposes of counting, we actually excluded September. So here it is. Since the asset was acquired on September 21, 20x1, which is last half of the month, then it is treated as if it has been acquired on October 1, 20x1. This is the normal situation or case. So September 21 is beyond September 15. Therefore, it's no longer part of September. So we count from October, November, December. And in that case, going back, so aside from for straight line, which is simply the annual times 3/12, for SID, it's like we computed the 4/10. On top of that, there's 3/12. All right. And please take note there is salvage value. So we use our depreciable amount for straight line and SYD, but for double declining, we use the cost of 40,000 and carrying amount for the next years all throughout. All right. So that's our usual setup. Next, what about depreciation method is based on actual physical use rather than function of time. So in that case, we have here the activity or variable charge method. First is on units of production. So in this case, we are going to compute the depreciation rate per hour for the working hours or service hours method and per unit of output for units of production method. Then for this one, we have to take note that if the asset is not used, so 0 production, 0 output, 0 working hour, therefore the depreciation charge is also 0. Right. And then for the units of production, we also have to take note that we develop again the service hour rate or depreciation rate, which is simply the cost or whatever is the cost divided by the total service hours estimated that can be done over the life of that PPE. And then for units of production will be whatever is the depreciable cost, we divide that with the total number of outputs expected to be produced over the useful life of that property, plant, and equipment item. This is not, again, based on time. So here it is. Let's have the service hours method here, manufacturing hours, and then we have the units of production method. Our cost is 100,000 minus 20,000 residual value. Therefore, that's 80,000 pesos depreciable amount. And we use that to get our depreciable rate. So 80,000 divided by 160,000 that means that it is 0.50 per unit of output. For manufacturing hours, that is 80,000 divided by the 40,000 equals 2 pesos per hour or per manufacturing hour. So to compute our depreciation expense, simply multiply or simply compute by multiplying the 0.50, our depreciation rate, times the units of output, or the 2 pesos times the manufacturing hours. And we construct the table. So same concept, depreciation expense, total of accumulated depreciation is the total of depreciation expenses, and here are our carrying amounts or values. And we've said that. Now, there are also other depreciation methods actually. Some depreciation methods are not tackled here though. Again, it's not our scope for this particular level, or it's already beyond what we are expecting or we want for the course. Anyhow, there are also other methods. Examples would be on certain items that if we think of cost benefit approach, that we want the benefits to be higher than the cost, it would be impractical for the company to use the above methods for low valued and certain items that are regularly acquired and disposed of. So one example of that would be tools and other implements like small tools, let's say the kitchen utensils used by entities engaged in catering services, wherein they can be deteriorated easily. They can be more than 1 year in terms of usage, but in that case, again, because of the amount or value, it becomes impractical. So there are some methods for that which will not be tackled here, but the concept is at least explained by us. Anyway, we can do, for example, inventory method. Example, any utensils that are no longer to be used, let's say out of the 100, we found out that the 5 are no longer conducive and are no longer usable in terms of our catering services. So meaning the 5 becomes expense. That's it. That's one method of other depreciation methods. And normally when we are going to do that depreciation, it will be on a group basis. So we combine, we group all tools, and we analyze accordingly. All right, next, for leasehold improvements, as explained, these are certain improvements done on rented properties. And in terms of depreciation, that would be the useful life of the improvements or the remaining lease term, whichever is shorter. Then, since leasehold improvements are transferred to the landlord, any residual value is ignored also. We have to take note, guys, that leasehold improvements are basically part of PPE. And then in some authors, in the last paragraph, if you are going to read, there is a conflict, but I would really say that leasehold improvements are PPE because they're tangible assets. They have physical substance. If we talk about, for example, let's say intangible assets, we have lease rights, but that will not be tackled here. So we focus on leasehold improvements. Anyway, here's an example. The contract is 10-year lease, and then there is an option to renew, in which if it is to be exercised, if it is clear that it will be exercised, then we are going to add that, include that to the computation of what would be the remaining lease term. And then during the first half of January 1, 20X2, or in that particular year, ABC company incurred the following costs. So there are general improvements, and then furniture and equipment, and assembly line equipment with their respective useful lives. At the time the leasehold improvement were finished, ABC company is uncertain as to the exercise of the renewal option. So in other words, no lease extension, so 0. The useful life is 10 years based on the first item, 900,000. The rest are for the meantime suspended. Then remaining lease term is 9 years. Why? We signed the contract January 1, 20X1, and now this is 20X2. Therefore, remaining is 9 years. So the shorter is 9, 10 versus 9. The option for renewal is disregarded since or because it is uncertain, as clear as that. The 900,000 divided by 9, so we just use or simply use straight line method, equals the depreciation expense of 100,000 for every year. Then for the latter two, these are clearly not leasehold improvements. These are equipment. So we present them as separate part of PPE, in which we just have to follow our basic rules. So whatever would be the depreciation method, and then we just have to take note of the useful lives. Now, what if, for example, ABC company will exercise the renewal option? So this would make our overall lease term as 14 years. And the shorter of the two would be 10 years. So that's why 900,000 divided by 10 years, 90,000 a while ago, that's 9 years, 100,000. All right, so that's for leasehold improvements. Now, what about if there would be a change in depreciation method, useful life, and residual value components? As explained, we have to account for such change as change in accounting estimate, because basically depreciation expense as computed is based on the estimates of useful life and residual value if there is. Then we account such change prospectively, meaning to say in the current and future accounting periods. So since prospective, no change to be made from the past periods. Instead, we simply get the carrying amount, and based on the carrying amount, we incorporate the change of the remaining life or useful life, or the revised, let's say, residual or scrap or salvage value. So I'm just summarizing the procedures that are actually made. But very important that if the entity presents only annual financial statements and the change occurs during the year, then the carrying amount is computed as at the beginning of the annual period. So example, January 1 for a calendar year period. If the entity presents interim financial statements and the change occurs during a particular interim period, the carrying amount is computed as at the beginning of that interim period. So if we say interim, it means, guys, other than annual, that's quarterly, monthly, or semi-annually. So if there's a change of a quarter, as if that begins at the beginning of the quarter. Let's say April 1, the second quarter, the first quarter is from January 1 to March 31. So if ever there's a change during the quarter, so as if it happened April 1. All right. So let's say, for example, illustration 1. There's a change in depreciation method from DDB, which stands for double declining balance, and SL, which stands for straight line. So in this case, this is what we are going to do. Remember, we have 20 million cost and then 10 years using double declining balance. So that's 2 over 10. Therefore, there's 20%. And to get the carrying amount in how many years, let's check. That's after 3 years, because it's from 20x1 and we change 20x4. So count 20x1, that's 1 year, 20x2, 2 years, 20x3, 3 years. So counting here is very important, by the way. So to get the shortcut of the carrying amount, this is actually an alternative solution that I did not discuss a while ago because I wanted you to focus on the tables, but we can actually make use of it for this. We can simply multiply 80%, 80%, 80%, and we get 10,240,000. Since this is the carrying amount, and based on the problem, we want to move to straight line. So the carrying amount is to be divided by the remaining years. 10 minus 3 years equals 7. And we get depreciation expense of this particular amount and journalize accordingly. All right, next, illustration 2. What if the method is from SYD to double declining balance. In that case, again, just compute the carrying amount, the remaining amount. So for SYD, remember, we are going to get the SYD denominator. The sum of numbers 1 to 10 is 55. And then it's still for 3 years. Therefore, we have to compute depreciation for our 3 years. So that's actually 10 over 55, 9 over 55, and 8 over 55. This is an alternative method which is shown, not the table or tabular formula, wherein, remember, we just multiply 20 million by the respective rates. But mathematical rules, or mathematically speaking, remember, if we have similar factors in the multiplication processes, like 20 million is common out of the 3 processes, remember, we can just add the non-common one. So we can just add 10 plus 9 plus 8, and we divide that by 55 multiplied by 20 million. That's the shortcut for accumulated depreciation. So you can check that out in your respective times. And we get carrying amount. Whatever is the carrying amount, we now multiply with our double declining rate, knowing the remaining life is 7 years. So 2 divided by 7 is 28.57%, and we get the depreciation expense. Next, illustration. What about if there's a change in useful life and also with our residual value? So simple, we just have to incorporate whatever is the residual value. So instead of 20M as our cost or depreciable amount, then we use 18M. Then it's from a movement of, let's check, straight line. Then, yeah, still straight line. If no mention of the change of depreciation method, it simply means that we are still using the same. That's the basic concept in accounting or business or finance, that if there is no mention of any change of one thing, that means it is still true. That's also the same thing under the law. So we have 20 million minus 2 million, 18 million times our 7 over 10. Let's check. That's still 3 years. Okay, so 3 years, that's why our carrying amount is 7 over 10. This is a shortcut, but we can have this illustration anyway. So like the long cut method, but this is what is shown normally in the notes to financial statements. So carrying amount is 14,600,000. And then remember, the revised residual value is 2.6M. So here, 12 million revised depreciable amount divided by the revised remaining useful life. It is said here that the total useful life of the asset really is not 10 years, it's really 15. So the remaining instead is 15 minus 3, 12 years. And that is under straight line depreciation method of 1 million pesos. Next, for idle, temporarily taken out of use and abandoned properties, meaning not utilized for the meantime, we are going to continue depreciating them. For fully depreciated assets, if ever the carrying amount is 0 or is equal to its residual value, we are going to recognize or remove them from our financial statements or records if ever they are no longer used by the entity and that they are really disposed of. Next, what about for improvements and replacements? If we say improvement, it is a substitution of a better asset for the one currently used. So example, before we have a wooden floor, now we replace that with a concrete floor. Next, what about for, let's say, a replacement? So for the replacement, we have a substitution of a similar asset. Let's say a wooden floor is replaced with another wooden floor, which is the same. Improvements normally would extend the asset's useful life. So that's why it will have to be capitalized as part of the cost of the asset, original asset. So example, we have 10,000 improvement cost, so we just have to add it, debit the equipment, credit cash. Then if ever we are going to example, have it, but it did not extend the life, no additional economic benefit. So the entry would be to debit accumulated depreciation by then. All right. So that's it for journal entries. Next, replacements of major parts. What if, for example, we replace a major part of an aircraft? In this example, it's not stated what part, but it's a major, and then the cost is 800,000. So what we can do then is, for example, if case one, the cost of the old part is 500,000, so that's credit. And then for the accumulated depreciation is we count from 20x1 to 20x5. That's 4 years. We exclude 20x5 because that's January 1, not an exact year. And that's 4 over 10. And the difference of the cost, 500,000, and act debt is the loss. So we treat it as a loss. And we are going to capitalize the cost of the major part, the replacement of 800,000, to the cost of the PP. And for the purposes of computing future depreciation methods, so we incorporate minus 500 and plus 800. For the act debt, that's minus 200. What if it is not determinable? So what we can do then is we use the old part. So it's 800,000 instead of 500,000. But if we don't have, for example, the 800,000, we can also use similar assets and we have to discount. That's also another option, but it's not shown here. For major inspections, we are going to incorporate that similar to replacement costs. And then major inspection is capitalized if ever there are additional benefits of whatever form. And then the carrying amount of the previous inspection is to be recognized. And then for previous inspection, rather, is the recognized, the carrying amount. For rearrangement and reinstallation, it's going to be a different thing, but same concept that if ever it adds more value to the entity, therefore we are going to include and exclude if not. For evaluation or evaluations of PPE, well, again, we discussed that evaluation surplus is part of OCI or other comprehensive income section. And then if ever, for example, there's an increase of a reversal of a previous impairment loss, that's now part of the gain, profit of loss. But then if ever there's a decrease of revaluation surplus, so that's still part of profit or loss. To compute revaluation surplus, this is our formula, as also discussed in our videos. And then let's say, for example, we have the given details and we are asked how much is the revaluation surplus. So simply that's FV minus carrying amount. And then after the revaluation, so whatever is the fair value, we divide that with the remaining useful life of 20 years to get the annual depreciation after the revaluation. So question though is, why do we revaluate? Because some assets actually, their values would change over time, just like the land, or perhaps there are some modifications of the PP item like the building. That's why we need to revalue. There are two methods, proportional or elimination. I love proportional because we just have to make tables of that. And then elimination is that the act debt is just deducted from the gross carrying amount. So debit act debt, and then we credit the furniture and fixtures, for example, an account title or sample from property, plant, and equipment. Okay, so this is an example of that. Let's say historical cost is 20M, act debt is 10M, replacement cost is 40M. Replacement cost means the cost in the current time if we would like to change or we would like to acquire a new asset, but similar asset to that. We have the following given items. Then we need to record the revaluation surplus under each of the following methods. So first is proportional method. We can get the fair value out of computing like the carrying amount portion of the replacement cost, and then carrying amount of the asset with historical cost assumptions. So that's 10M. So we get 18 million as our revaluation surplus. Remember, fair value minus carrying amount. And the deferred tax is 30%, assuming, because it changed nowadays for corporations in the Philippines. So it's 5,400,000. So we get the revaluation surplus net of tax. When we present items in our OCI section and our financial statements, we present that net of tax. For proportional method requirement, so we can actually see what we have computed so far. For the total economic life though, let's go back. We have effective life of 20 years plus the remaining economic life equals 40. So total economic life is 60 years by then. All right. So effective meaning current times and then plus the remaining economic. So from current to future. For proportional method, so we actually have to simply construct this table. So we have the given item, historical cost, replacement cost, and the increase or decrease. Carrying amount is at the bottom part under historical cost. Under replacement cost, our fair value or the DRC. If we use replacement cost, the term for this one, 28 million, is depreciated replacement cost, or basically also the fair value. And the revaluation surplus is 18 million. We can also, by the way, for 18 million, multiply that by 70% to get the net of revaluation surplus and deferred tax liability of the 30%. As to why that is deferred for taxes, that will be a discussion in other accounting subjects, but the basic concept is that it will have impact in the future times, not just today. So carrying amount after revaluation is 28 million, and this is the amount that we are going to divide by the remaining useful life. For elimination method, as what we've said, we are just going to simply have it here. So let's check for a while for the entries. So similar for the credit, revaluation surplus, and deferred tax liability, but we can notice that the act debt is eliminated, debited at 10 million, and whatever is the excess for the building. So the PPE seemed to be the balancing figure. And after that, similar amounts will be arrived at. So that's why they are options. But again, I like proportional method. So it's up to you guys what to use. Next, the recognition. For the recognition, by the way, again, this is the removal or exclusion of the value or cost of an asset or liability. In this case, the PPE. If that is disposed or sold and no more future economic benefits for that. So example here is if we sell the PPE under cost model, so all we have to do, the basic formula, guys, is just like exchange, fair value or the proceeds from the sale less carrying amount. So if we can really compute the carrying amount, that's it. How much is the carrying amount though? The cost is 100,000, act debt is 24,000. So take charge of the computation. So that's carrying amount of 76,000. Our proceeds is 28. 30,000 is the selling price, but there are additional costs. So we have to deduct, we have to net that to get our proceeds. So 30 minus 2, that's 28,000. 28 minus 76 equals 48,000 loss. So again, the formula for computing any gain or loss on sale is fair value or proceeds of the sale less any applicable selling expenses, and then less our carrying amount or book value. And that's also the same under revaluation model. So in this case, we have our proceeds of cash 1,700,000. Carrying amount is 2,300,000. The cost minus act debt of 800,000, that's 1,500,000. You can recompute. Then 1,700,000 minus 1,500,000 equals gain on disposal of 200,000. If you can notice, the revaluation surplus remaining balance will have to be transferred to retained earnings. As a continuation also of piecemeal realization for our depreciable assets with revaluation surplus. If you can recall, the revaluation surplus balance will have to be realized on a piecemeal, meaning on a step-by-step basis throughout the years for depreciable assets, but for non-depreciable one time when it is sold or disposed. Let's check. This is machinery. Okay, so depreciable asset, meaning the remaining balance only in the equity. Okay, so here is our alternative solution, which I liked or much better, since if the resulting amount is positive, that's gain. If negative, that is loss. And here is our summary. All right, so that's it.